back to full team coverage of today's real estate market. Your America's real estate investment source. Real Estate Radio USA.
All right, everybody, we are back. Now joining us on the program, he's a recognized expert for foreign securities markets as well as the currency and gold markets. Almost all of his predictions in 3 or 4 years have come to pass, including the collapse of the housing market, subprime crisis, decline of the dollar, increase in price of oil and gold, a regular feature on CNBC, Bloomberg TV, and Fox, as well as being frequently quoted in such publications as Wall Street Journal, New York Times, LA Times, Barron's Business Week. His first book, Crash Proof: How to Profit from the Coming Economic Collapse, foretold the current economic and housing crisis in stark detail. Please welcome to the program the President and Chief Global Strategist of Euro-Pacific Capital, Mr. Peter Schiff. Peter, how you doing, sir?
Great, Barry. Nice to be on your show.
Thanks for coming out today. You've been openly critical of the recently passed housing stimulus bill, calling it the most inflationary legislation ever enacted. And you said that because of the money needed to pay for it, the bill will actually cause consumer prices to soar. Why is that?
Well, you know, the reason that consumer prices are already rising to the degree that they are, and of course they're rising a lot faster than the government admits to with its own indexes, is because of the money that we're creating. I mean, the Federal Reserve is creating too much money, and when you have more money, prices go up. You make the value of money go down. You know, just like in real estate, if you've got a lot of property on the market, it's not worth as much as if there's very little property for sale. It's supply and demand. And so if you've got more dollars in circulation, the dollars have less value, and so prices have to go up. And that's why oil is as expensive as it is. That's why food is going up in price. It's all a function of the dollar losing value. And we're going to have to create a lot of dollars to refinance all these mortgages, to buy up all this bad debt, and that's going to cause prices to rise.
When you say create the dollars to buy back these bad mortgages and turn that around, where is that going to come from? The private sector? Is it going to come from the government?
Well, the government creates the money. The Federal Reserve just prints it. I mean, what they're going to do is they're going to forgive a substantial percentage of this mortgage debt. And, you know, where's the money going to come from? I mean, the Fed's going to create it. The Fed's going to buy up these mortgages. I mean, the lenders are going to take some losses, but there's going to be a lot of losses that are just going to be borne by the government, and that they're going to create money.
With your background and what you just said, that the lenders are going to have to basically eat some of this principal and write down some of this debt, would it not make sense to pass it on to some of the people who could stay in or would be willing to stay in these homes rather than booting them out and then having to resell the debt?
I mean, what makes sense is for the government to stay out of it and let the borrowers and the lenders negotiate between themselves. You know, and that way you're going to get real solutions that make sense because the parties are going to willingly agree to it. You know, in some cases, people should stay in the homes and have their mortgages reduced, and in some cases they should be kicked out. But you have to let the parties determine this for themselves. You can't have the government coming in. And, of course, the bigger problem is their bailout of Fannie Mae and Freddie Mac, which they should have let go bankrupt. They never should have created those monstrosities in the first place, and they should have taken the opportunity to let them go bankrupt. But instead, they've now made their implicit government guarantee explicit, and so instead of insuring 50% of the mortgages, in a year or so, they're going to be insuring over 80% of the mortgages. And, of course, a significant percentage of these mortgages are going to go bad because people just borrowed too much money. Houses are not worth anywhere near the prices that people have been paying for them for the last several years, and so these mortgages are not worth their face value, and it's going to be trillions of dollars of losses.
Now, what's the incentive, like you said, if the bank and consumer work together and keep government out of it, what's the incentive for the bank to write down some of these mortgages?
Well, the incentive for the bank is I loan somebody, let's say, $500,000 to buy a house that's now worth $300,000. Right. Now, if I can't work out a deal with the current occupant, he just sends me the keys and goes and rents a house next door that's probably just as nice for half the price. And so the incentive is, I don't want that property on my books. Even if I foreclose and sell it, if you look at the recovery rates right now, it's about 40 cents on the dollar nationwide. That's all they're getting. So the incentive for me as a bank is, I don't want that house. And I know you're not going to make the payments on a $500,000 mortgage when your house is only worth $300,000. So why don't I work out a deal with you where, rather than foreclosing? But the thing is, what I would want if I was the bank, I might call the tenant that was in there or the owner of the house and say, look, you've got a $500,000 mortgage and you're not paying it. How about if I reduce it to $300,000, but you cut me a check for $30,000? You at least give me something to show that you've got some money, you're going to have some skin in the game. I want you to put hard-earned money into this house so that if a year from now the house is down to $250,000, we're not having the same conversation.
Right.
Now, if the occupant is so broke that they don't have a dime to put into the deal, then maybe they just assume foreclose and sell it to somebody who actually has cash. Because I don't think it makes sense to have people owning homes that have no money.
Right.
Because owning homes are very expensive. You know, they're not assets, they're liabilities, they're money pits. When you own a house, you got to maintain it. That costs a lot of money. And if you don't have money, then you should be renting. Because when you're a renter, your landlord takes care of all those things, all the busted pipes and the leaky roofs. The landlord will fix that. If you don't have any money, you have no business owning a house.
I couldn't agree more. One of the things you mentioned, and we completely agree with, is the laws of supply and demand. I saw that on your website and some of the articles you wrote. We talked to so many realtors, so many people in the game, and we're told over and over by people who don't have an economic background that supply and demand is irrelevant when it comes to real estate. I know you're going to laugh at that. Can you, without sounding like a realtor?
Well, how can it be irrelevant?
I don't know.
It's
and
local.
It's
Yeah.
whatever.
Well, you know, when I used to joke, when these realtors used to try to convince me to buy a house years ago, and they would say, you know, they say there's all this demand and there's no supply. I would say, well, look around you. I say there's millions of houses. There's plenty of supply. It's just that it's not for sale right now.
Right.
And I said there's a lot of demand because there's a lot of credit flowing, and people want to buy houses because they think the price is going up. So, you know, you have a lot of supply, a lot of demand and a limited supply. But I said just wait a few years because it's going to turn around. All these houses that are not for sale are going to be for sale, and no one's going to want to buy them because nobody's going to be lending. And no one's, so, you know, it's all a question of, you know, a moment in time. Right now, it's turned around. There's everybody wants to sell and nobody wants to buy.
Now, understanding that now you've got an oversupply of inventory is a huge, overwhelming supply of inventory. You've got a low demand from buyers. Based upon economic indicators that you read, I know we're not at the bottom. Do you foresee when that bottom will be, and what can we look for?
No one's going to make any money in real estate for at least another decade or more. You know, real estate prices got so overinflated, and real estate is so overowned as an asset class, and we've just built so many houses and condos over the last few years that prices are going to be in decline in real terms for a long, long time. And, you know, that doesn't mean that people can't buy houses. That just means don't expect to make any money. When you buy a house, think about it the same way you buy a car or that you buy a boat, right? When you buy it, you know it's going to go down. But people buy cars anyway. People buy boats, even though they know they're going to depreciate.
Correct.
Because they're buying something that they want to own for the enjoyment. That's what houses are. They're not assets. They're not going to appreciate. They're consumer goods like cars and boats. And, you know, the bottom in the market is a long way down. I mean, you know, unfortunately, and I do think that real estate at some point will be a good investment in that I think real estate's going to get so dirt cheap for a while that you're going to be able to buy homes for a fraction of the cost to build them and the land value. And that's going to be a function of all the distressed property that's going to come on the market in a recession that's going to be very severe. So before real estate prices eventually level off to, you know, a normal historic norm, where normally real estate, let's say homes would be worth about 2 to 3 times the median household income in a particular area. So if median household income in your state is $40,000, you know, $50,000, let's say, you expect the median home price to be $100,000 to $150,000. If it's $200,000, $250,000 right now, you know that it's going to go down. But in a depressed market, maybe houses will go down to 100% or maybe 125% of median family income. I think they're going to get very, very cheap. So you can see houses falling in price, you know, from peak to trough, you know, 60, 70, 80% from top prices to bottom prices before eventually leveling off at some point down the line where the prices are maybe half of what they were at their high. But before they get to that fair value, they're probably going to get very cheap because of the abundance of sellers and foreclosures and bankruptcies and a real credit crunch, which makes it very difficult for anybody to buy a house unless they have, you know, the cash.
So it's basically the perfect storm is happening right now. You've got a tightening crunch of lenders. You've got foreclosures and of course the declining values all coming together where it's a perfect storm. Yeah,
you know, I was listening to this guy on television today. They were talking about a survey that came out by this online real estate site, Zillow.com,
right,
where 1/3 of the people who bought homes in the last 5 years are now